Meet Tyler. Tyler has been trading for exactly 6 months. In Wall Street years, that makes him a toddler holding a stick of dynamite. His portfolio is up 400% year to date because he went all in on a crypto token based on a blurry JPEG of a sneezing panda. His confidence is currently orbiting Mars. Tyler's hobbies include misquoting The Big Short, explaining Web3 to terrified Uber drivers, and unironically using the phrase "generation wealth." Naturally, Tyler decides he's too talented for a 9-to-5. He calls his broker, lies about his liquid assets, and gets approved for options trading. He doesn't know what a Greek is, but he assumes it's a type of yogurt. His strategy? It literally can't go tits up. His risk management? Deleting the app when the numbers are red. His fiance's concern? Why the honeymoon fund is now invested in deep out-of-the-money calls on a dying cinema chain. Fast forward 3 months. Fed hikes rate. The music stops. Tyler's portfolio is down 92%, and his fiancée is currently Googling, "Can you annul a marriage based on financial infidelity?" This brings us to the uncomfortable question. Why do the dumbest investors usually win right before they lose everything? It's the Dunning-Kruger effect, the financial version of Darwinism. It explains why smart people are terrified of the market, while Tyler thinks he's the main character in a movie about his own genius. While traditional investors are looking at cash flow and fair value, the Tylers of the world are buying companies trading at 600x earnings because they saw a meme about it on X. As the legend goes, why buy Berkshire Hathaway when you can buy Fartcoin? Here is the harsh reality. We have been in a historical bender of a bull market. Since 2009, the S&P 500 has basically been on a limitless pill. When the ocean is rising, even a leaky boat floats. In this environment, irrationality is a superpower. If you were prudent, you made 10%. If you were reckless, you made 1,000%. But like all great benders, the hangover eventually hits. When the market turns, you have 2 options. Option A, sit on cash like Buffett and be bored. Option B, keep gambling, lose it all, and then blame market manipulation. Tyler chooses option B. He doesn't blame his lack of skill. He blames Jerome Powell, the Illuminati, and the algorithm. So, what is the technical reason Tyler briefly outperformed a Harvard MBA? The answer is beta. Think of beta like spicy food. The S&P 500 is a bell pepper. It has a beta of 1. It's safe, it's mild. Tyler's portfolio is a Carolina Reaper. If a stock has a beta of 3, it is 3 times more volatile than the market. When the market goes up 1%, Tyler's high beta trash stock goes up 3%. Tyler feels like a god. He books a table at Nobu, but beta cuts both ways. When the market drops 1%, Tyler drops 3%. Gravity hits his portfolio harder than anyone else. Suddenly, Tyler isn't looking for tables at Nobu, he's looking for the unsubscribe button on his life. In a bull market, a high beta portfolio makes you look like George Soros. In a bear market, it makes you the top post on loss porn Twitter. So the next time your friend brags about his 10-bagger meme coin, just remember, everyone is a genius in a bull market, but only the smart ones get to keep the money. Don't be Tyler.